As the economy picks up, many people are looking to make more charitable donations. So why not do it in a way that'll save you some tax dollars? I'm Tracy Capelman. Join me right now for your Wealth Health. Hello and welcome to Your Wealth Health, a show focused on helping you manage your money. I'm your host, Tracy Capelman, and I am here today with Cliff Hawkins, a private wealth advisor who has over 15 years of experience putting clients and their financial well-being first. Now, Cliff joined Hilltop Wealth Solutions in 2020 and integrated his own practice with the firm. It is so great to see you again, Cliff.
It's good to be here, Tracy. Thanks.
Well, this week we're going to discuss key charitable gifting strategies and what will work best for you. Now, Cliff, donating to your favorite cause usually isn't a one-step process, especially if you're going to be setting up a long-term strategy. This is particularly true if you want to make sure you're being tax efficient while also benefiting the person or the organization to which you're donating. You know, at a time like this, with so many people having lost months of work due to the pandemic and gas prices on the rise, this is a very important topic to help people save a few extra bucks. And since 83% of charities nationwide reported a decline in revenue during the pandemic, this really can get people to start thinking about what they might have to offer in regards to donations. So to start, Cliff, would you mind giving us some more insight into how tax breaks work with charitable giving as we stand right now in 2021?
Absolutely. Well, a couple of things to take into consideration is because of the Tax Cuts and Jobs Act, the standard deduction was increased, so less people started itemizing, which meant charities were receiving less. So in 2019, about $57 million less was given to charities than previous years, and about 21 million people are now not contributing to charity simply because they're taking the standard deduction versus itemizing. Now, a few things people can do. Because of the CARES Act, there are a few things that went into place, and one was a cash donation where people could take up to $300 and get that as a above the line deduction right off the top. Well, that was extended this year as well, and it was actually enhanced. So this year it's $300 per person. So if you're married, you can actually take up to $600 off right out of the top above the line deduction, even if you are using a standard deduction. So that's what's important about that. So even if you're using a standard deduction, you can take up to $600 off for the above the line if you're going to do a cash donation. Another neat thing that was also carried over for 2021 was the pause of the 60% adjusted gross income rule. And what that meant was if you were to do a qualified cash donation, you could deduct up to 60% of your adjusted gross income. Well, that was paused due to the CARES Act. With the pandemic, it was changed to 100%. And that is also in play for 2021. So currently, someone who is doing a qualified cash donation can donate up to 100% of their adjusted gross income. So those are a couple of things that people can take into consideration.
That's really some great information. And Cliff, this might be hard to say, but what are the best ways to gift? I mean, obviously we can give cash or write a check, but you also mentioned just that, people gifting stock to a child or a grandchild. What exactly does that look like?
Yeah, so to your point, Tracy, there are a number of ways to give, right? I'm not sure they're the best way to give, but giving stock is one of the ways that people are giving to children, to grandchildren nowadays, because when you give an appreciated asset, what happens is you as the donor will no longer have to worry about being taxed on the unrealized gains. So as you pass that on to the, let's say a grandchild, for example, as you pass the qualified appreciated assets on to the grandchild, you no longer have to worry about any capital gains that you have to pay on any of the appreciated stock that you just passed on. So a lot of people are doing that because it's a way to kind of move some assets off the table, and also giving a great gift to someone that, as it does appreciate over time, could be worth a lot.
Absolutely. That really makes the case for whether to gift assets to those you love while you're still alive or to keep it as part of your estate after you pass away. Now, isn't there also some sort of tax break given annually when you gift a certain amount to an individual or an organization?
Yeah. So what you can do now is you can, let's say you want to cut a check to someone. You can donate, or you can give rather, up to $15,000 a year, every single year, to a person and or persons and or charities. And how that works is, if you're married, that amount will double. So if you have 4 children and you and your wife want to give to 4 children, you each have $60,000 that you can give. That's $120,000 again that you're removing off the table, assets from you, and you're giving them now so you can watch the people enjoy them. Whether it's a charity, you can watch the charity enjoy it. So it's a way of giving while you're alive, and it doesn't count against your annual exclusion because it's under the $15,000 limit.
Absolutely. Another incentive to gift now rather than later. Well, that covers what to do with appreciated assets, but are there any other limits when it comes to gifting to children and grandchildren?
It's really similar to the $15,000 limit. So as long as you stay under that, the same situation can apply. Let's say grandchildren, for an example, and you have 2 grandchildren, and you really want to give them something. You want to see them use it. You want to be part of that. Again, if you're married, you and your spouse can give your grandchild each $30,000. Without you having to worry about any of that going towards your annual, or it won't. Your annual will be 30,000 apiece, but it won't go towards your lifetime estate tax. So that's really another way that you can give. Really, again, no different limitations whether it's the grandchildren or the children.
Another thing I'm really curious about is, what if you want to distribute a gift through your retirement account?
Yeah, so I believe we have a chart I'd like to show. And what it's called is called a qualified charitable distribution. And it works when you're over 70 and a half. So that's kind of the trigger. It's 70 and a half, and it is one of the best ways to give because it also helps the donor satisfy their RMD, or a required minimum distribution. So if you look at our case study here, we have a client who's 81 years old, and he wants to give $10,000 to the charity. Now, the $10,000 will satisfy his required minimum distribution. It will also be reported as taxable income. So he's going to get a tax bill, and let's say he's at a 22% tax bracket for $2,200. So the total cost for the contribution to the charity will be $12,200. And let's assume he's been making charitable contributions since 2010, total contributions of $100,000. He's paid more than $22,000 in taxes. And if you look over to the right there, it starts in your IRA. It has to go into your checking account. So again, that's what makes it taxable. And then it goes to the charity. That's a non-qualified charitable distribution. A non-QCD is what most people do. So if we're looking to do a QCD, the next chart we have here, this would be our recommendation. The charity gets the same $10,000. The $10,000 also satisfies the required minimum distribution, so the client doesn't have to worry about that. The $10,000 is excluded from his taxable income because it goes to the charity via the QCD. His tax bill is zero, so the total cost for his charitable contribution or her charitable contribution is $10,000 minus the $2,200 they're saving, versus doing the non-QCD option. You get ongoing tax savings. The charity wins, the client wins, and on the right-hand side there, you see it goes straight from the IRA straight to the charity.
So there's a big tax benefit there. Wow. Well, I have just a few more questions about charitable gifting, but first, I understand you have a special offer today for some of our viewers who might need guidance. They might need a second opinion on these kinds of financial decisions. And just like the things we're discussing today, you guys are there for that.
Absolutely. So, we're given a no obligation second opinion, 30-minute phone call to anyone who calls in and requests. What we'll do is we'll learn a little bit more about their situation. We'll explain what we do and how we work with our current clients and how we could potentially help them. We're not pushy. We're not salespeople. Everything is just simply advice driven. So it depends on their situation, but we'd love to hear from you and see if we can help you out as well.
Sounds like an awesome offer, Cliff. Now back to the topic of charitable donations. What about the gift of college savings? Now, this is something that's on so many people's minds. I know definitely in our family, we're so focused on that right now, especially with the cost of college going up as the years go by. I have a daughter that wants to go to medical school.
Wow.
Man, I know that 529 plans can be used to help pay for expenses, but tell our viewers, how exactly do they work?
Yeah, so a 529, or we sometimes call it a 529, it's a tax advantage savings plan for college, higher education. It can be invested in certain vehicles, so it will grow very similar to an investment. And when the money is being pulled out to use for tuition, other things that you would use, for higher education, it's tax free, so you don't have to pay any taxes on it. So it's a great benefit for parents to use. It's a great benefit for grandparents. There are no contribution limits, so you can put quite a bit in it. It just needs to be, the amount in there really needs to be similar to the amount that's going to cost for college. You can't put in, $500,000 and college costs $20,000 because they're not going to fall for that.
Well, Cliff, you've done a really good job of explaining to us how to give, but do you have a strategy for helping people determine how much they should give? As you just indicated there, that can be tricky too.
Yeah, absolutely. And Tracy, here's the thing that not everyone wants to give. Not everyone is charitably inclined. We have a lot of clients that are in our ski club, spending kids' inheritance. So they have no interest in that. But those that do want to give or want to give to charities, what we do is we sit down and we go over their financial plan. And we start to determine what buckets of income, what income streams do we want to use to make these charitable contributions. And then from there we decide the amount, and we do it in the most efficient manner for each client.
So glad we've discussed this, because it is important to give back for some of us, and what better way to encourage people than to show them the best ways to do it. Any other thoughts for us today?
Some people want to give, but they're afraid of having their name out there. So they want to give anonymously. So there's ways to do that. You can create an entity, and your name won't be on it because the check will come from the entity. So that's one way to keep you anonymous. Nowadays, you can donate for almost anything online. And there's usually a box where it'll ask if you want your name to be broadcast out there. So that's another way to donate anonymously. And lastly, another one, it's more of a high level. It's called donor advised fund. It's a way to donate anonymously as well. So there are several ways to do it.
Great options for those who want to remain anonymous. Well, we are out of time for this edition of Your Wealth Health. For Cliff Hawkins and the entire Hilltop staff, thanks for being with us today, and thanks for watching. Stay wealthy, everyone. We hope you found this discussion helpful today. Don't forget to like and subscribe to our channel for new content weekly.